Welcome to another episode of Let's Break It Down with Nkubi. Today we're dissecting a fundamental question that lies at the heart of modern business. Why do major companies have multiple shareholders instead of being owned by one person?
At first glance, it might seem logical for a single visionary, an Elon Musk, a Jeff Bezos, or a Johann Rupert, to own their company outright.
After all, wouldn't that simplify decision-making and ensure a clear strategic direction? And yet, the world's most powerful companies don't operate this way.
There's a reason for that, several in fact.
Today, we'll explore why shared ownership is a defining feature of corporate success, how it fuels economic expansion, and why the companies that shape our world, from Tesla to Nestle, rely on thousands, even millions of shareholders. But before we dive in, don't forget to subscribe to Let's Break It Down with Nkubi on YouTube, LinkedIn, Facebook, and our upcoming website for more insights like this. Now let's begin. Ownership and power in a capitalist world is that history is filled with figures who built empires single-handedly: Carnegie in steel, Rockefeller in oil, Ford in automobiles. These were men who owned vast enterprises outright, wielding unchecked power over industries that shaped nations. But today things look different. Companies like Apple, Amazon, and Toyota have dispersed ownership across millions of investors. Why? Because modern economies are built not just on ambition, but on shared risk, capital efficiency, and governance. This isn't just about finance, it's about how power and wealth are structured in the modern world. You may be asking yourself as to why don't major companies have just one owner? To understand this, we need to break down some core business concepts: capital growth, risk management, liquidity, governance, and innovation. Let's start with the basics. What is a shares and why do companies issue them? A share represents a fraction of a company's ownership. When companies issue shares, they raise money from investors in exchange for ownership stakes. This process allows companies to, first, fund expansion; second, develop new products; third, spread financial risk; four, increase public trust. The total value of these shares determines the market capitalization of a company. For example, Tesla's market cap is around $1.3 trillion, but Elon Musk owns only about 13% of that. Why? Because Tesla didn't grow through one person's wealth, it grew through the collective investment of millions of shareholders. 10 reasons why companies have multiple shareholders. Let's start with raising capital. Without debt, a company like Nvidia or Volkswagen needs billions to invest in factories, research, and supply chains. Instead of relying on bank loans, they issue shares, allowing investors to fund their growth. Moving on to spreading financial risk, no company is immune to economic downturns. With multiple shareholders, the financial burden is distributed, reducing the impact on any single entity. Let's talk about creating a market for shares: liquidity. When a company is publicly owned, anyone can buy or sell shares on the stock market. This liquidity makes companies more valuable because investors can exit easily if needed. As we move further, ensuring accountability. With multiple shareholders, decision-making isn't concentrated in one person's hands. Instead, boards of directors and investors hold leadership accountable for their actions. Now on to encouraging innovation. Companies with large shareholder bases can attract funding for ambitious projects, whether it's Tesla's self-driving technology or MTN's expansion into 5G networks.
Let's dive into understanding employee shareholding and incentives. Many companies offer employees shares, ensuring they have a stake in the company's success.
This aligns employee efforts with long-term growth. We can't forget attracting top talent. Executives and industry leaders prefer working for companies where they can earn stock options. This has been a key driver in the success of companies like Google, Apple, and Microsoft. Of the most important, strengthening public trust. A company with thousands of shareholders gains public legitimacy. Governments and regulators are more likely to support companies that have broad investor participation. What about legacy and long-term growth? Privately owned companies often struggle with leadership transitions. When ownership is spread, companies can survive generational shifts. Think of Nestle, established in 1866, and Toyota, established in 1937. Another critical reason is the global expansion and market power. Companies that sell shares publicly can scale rapidly.
This is how firms like Amazon, ShopRite, and Safari.com have expanded beyond their home markets.
Let us look at global examples on how shareholders shape business power. 1. USA. Tesla, Microsoft, Amazon. Trillion-dollar companies with millions of investors. 2. Europe. Volkswagen, Nestlé, BP. Dominant players with institutional shareholders. 3. Africa. MTN, Safaricom, Dangote Group. Publicly traded giants shaping regional economies. 4th, South Africa, Naspers and ShopRite. Key players with global influence. Each of these companies could have been privately owned, but public investment allowed them to scale beyond individual wealth. In summary, here is the power of shared ownership. If one person owned an entire company, they would face significant challenges. Limited capital. They would have to fund everything alone. High risk. If the company failed, they would lose everything. No market liquidity. No easy way to buy or sell shares. No accountability. No one to challenge bad decisions. Limited innovation. Expansion would be slower and more costly. Instead, shared ownership creates a system that benefits everyone, from the investors to the customers to the employees.
Recommended book: The Intelligent Investor by Benjamin Graham. If you want to understand how shareholder-driven companies work, read this book. It's considered the Bible of investing and is one of Warren Buffett's favorite reads.
Final thoughts and call to action. Now that you understand why companies have multiple shareholders, what's your perspective?
Would you invest in stocks, or do you believe private ownership is the better path?
Let me know your thoughts. And before you go, don't forget to subscribe to Let's Break It Down with Nkubi on YouTube, LinkedIn, Facebook, and our website for more high-level business insights like this. Until next time, keep thinking critically, keep questioning, and keep breaking it down.